Hi, it's Michelle with Trade on the Fly, and today we're going to take a look at using technical indicators, specifically taking a look at the slow stochastics. Why use a technical indicator, you might ask? Technical indicators can help guide us. They can help us confirm what we're seeing in price action, and it's another way to interpret price. Some technical indicators can help foreshadow changes in price, but we must be very mindful and make sure that price confirms, that we're not trading solely off of the technical indicator, and that we remember that price and volume are first and foremost in our trading. It's important to understand how the technical indicator works and what environment it's going to work best in. And more is not better here. If you choose to use a technical indicator, pick one or two, become intimately familiar with how they work and how they're going to work into your trade plans and into your setups. So let's take a look at the slow stochastics. The slow stochastic is a bound momentum oscillator. It's going to follow the speed or momentum of price, and in general, momentum is going to change before price itself actually changes. So with the slow stochastic, it's made up of the percentage K and the percentage D. So technical indicators all have a formula that they come from and different criteria that make up those formulas. And in simple terms, to not go into great details, the K percentage is going to be your look back period. So the number of periods in the time frame you're using that indicator in that the formula is going to go back and grab information from. So whether that's a weekly, a daily, or an intraday chart. And then the percentage D is going to be the simple moving average that you use to help calculate that formula. And a very common one that you'll see on daily charts in most stock or most chart platforms will be 14.3. So 14 would be the percentage K. It's going to look back 14 periods. And then 3 being the percentage D is going to be the 3-period simple moving average. Using the slow stochastics, what we're looking for is overbought and oversold readings to help us look for our entries in the time frame that we're trading. So overbought readings are going to come from the slow stochastic getting over that 80 mark, and oversold levels are going to come from the indicator getting down below the 20 mark. I prefer using the slow stochastic versus the fast stochastics simply because the way that it's calculated, it makes it a smoother indicator to use. The fast will tend to be more choppy and have more back and forth, and I just personally prefer the smoothness that I see in using the slow stochastics. So no right or wrong, just personal preference there. So what environment does the slow stochastics work well in? It's going to work well in range or chop. We want to be able to identify back and forth action so we can look for those overbought and oversold levels. In strong trends, the slow stochastic is not going to work as well because it's trending and that indicator can stay overbought or oversold for extended periods of time and becomes much less useful in our trading. So how do I use slow stochastics in my personal trading? I'm going to look for overbought or oversold levels within a range, and I'm going to combine that with trend lines or support and resistance levels to help me identify good risk-reward areas for entries on my setups. So let's take a look at example here. Here's a daily chart on RGLD, and you can see that the slow stochastic is set to the default of 14.3. So I'm going to look and identify a range that I can make sense out of. I'm going to start looking for overbought levels and oversold levels within that range as the price changes. I'm going to start using support and resistance levels and trend lines to help guide me in looking for entries off the top and the bottom of that range. Now, that's certainly not to say that I'm going to trade the exact top or the exact bottom, but I want to remember that if I can get the middle of a lot of these moves, they can be fairly stress-free trades and some fairly nice gains in the middle of those trends between the overbought and oversold levels. Here's another example using an intraday chart. It's a 15-minute chart on KITE. And again, we're just looking to identify some range and then looking for the overbought and oversold readings with my trend lines to help find areas that make sense intraday that I can trade off of those overbought and oversold levels. CRR is an example here that I wanted to show you where when a stock starts trending, how the slow stochastic is maybe less useful, or we're going to use it in a different way than we do in a range. So in this example, CRR makes a really nice break higher in price on very heavy volume, and the slow stochastic gets to overbought levels. Now at this point, using it in a range, we would expect to get a big reset in price off of that overbought level. But instead, what happens here is we end up getting a little bit of a pullback in price, but a lot of digestion sideways here, digesting that big move that it had on heavy volume. And as that happens, the slow stochastic works its way from overbought down towards oversold. And this is very bullish action. When we see this happen, it means that the stock is starting to trend and it's consolidating those gains. So when we see that happen, what we're looking for off of those overbought levels is to see price break higher out of that range, which we get another nice break higher out of that range, and then again reaches overbought levels, works off the overbought down to oversold more through time than it does through price. Here's one more example I wanted to show you with BITA. Again, another example when a stock starts trending that the slow stochastics can stay overbought or oversold for extended periods of time. So in this example, BITA continues to trend lower in price, reaches oversold levels, and continues to stay oversold levels. And you'll get some bounces along the way off of the bottom, but nothing meaningful. And that's why it's important with the slow stochastic to incorporate your support levels or your trend lines to help you, because otherwise you may just be thinking once it reaches oversold, you should get a nice bounce out of it. And when something moves from a trading range into trending, you're not going to see those bounces. But what we can look for in this example is once the stock retraces to a support level that makes sense where we may see a bounce from, we can combine knowing that we're at oversold levels with our trend line and look for a break back up through that trend line and off of oversold levels for a bounce. I hope this helped you get a better understanding of how slow stochastic works, and if it works into your trading and your trade setups, that's great. If you'd like to learn more, go to tradeonthefly.com.